Hello, and welcome to Financial Fluence, where we'll teach you the most up-to-date strategies and tricks for making money online. Don't forget to subscribe to the channel, hit the like button, and turn on the notification bell to be notified every time a new video is uploaded. Also, don't forget to leave a comment down below. In today's video, we'll talk about how you can survive an economic recession. You could lose everything if you aren't prepared for an economic slump at all times. When a financial crisis strikes, it's not uncommon for people to lose jobs that give them the illusion of security. Their retirement funds may be halved, and they may even lose their home to the bank. All of these things could have long-term health consequences as well as strained relationships. When the economy has been performing well for a long time, it's easy to forget about the times when things went wrong. However, there is never a period when the consequences of slowdowns should be minimized. Fortunately, when the economy suffers a downturn, those with a high level of financial stability benefit greatly. This may give individuals the potential to amass great wealth beyond their wildest dreams. If you understand how to properly prepare for bad situations, you'll be able to seize opportunities when they arise. A recession, in broad terms, is a significant drop in economic activity that lasts more than a few months. It can be triggered by a wide range of causes, including inflation, which occurs when prices rise and the dollar weakens. When prices fall and the dollar buys more, this is referred to as deflation. In lending problems, high interest rates are a problem. Higher unemployment, a loss of consumer confidence, people losing their homes, and firms going bankrupt are all common outcomes of these concerns. The stock market often plummets as a result of these concerns, as investors panic. They lose faith in the market and withdraw their funds. To improve your finances at any point in the economic cycle, you must develop the patience of living below your means and spending less than you make. The difference between your income and spending is utilized to save for the future and pay off debt. Unfortunately, many people fall into the trap of increasing their costs in direct proportion to their income, resulting in an endless cycle of barely scraping by. When they earn a raise, the money is spent on a new automobile or a bigger house right away. And when their tax refund arrives, it's already spent on a vacation. The phrase, living below your means, may conjure up connotations such as boring or mundane. However, there will be so many wonderful changes in your life once you start doing this. Did you know that the average billionaire earns money from 7 different sources? They don't rely on a single paycheck from their employment to pay for their house, vehicle payments, and other expenditures. And they don't live in constant fear of losing their job. When your revenue is diverse, you have less reason to be concerned if one stream of money fails. When you combine living below your means with diversifying your sources of income, you'll be able to pay your payments even if anything bad happens. The possibility of one particular revenue stream taking off is possibly the best advantage of having numerous paths that offer you income on a regular basis. For example, a person who has a 9-to-5 job starts detailing vehicles on weeknights and weekends as a side hustle. Customers are lining up for car detailing services, which proves to be a success. It ends up being a much higher paying hourly job than a 9-to-5 one. They can now quit their full-time job and concentrate solely on the detailing business, which pays double or triple what they were previously paid. It makes sense to pay off high-interest debt quickly and low-interest debt slowly, instead of using every extra dollar to pay off low-interest loans. Invest it to generate more income. Consider whether investing more money to earn 10% is better than paying off debt at 3%. Mathematically, this makes sense, but some people forget the fact that with little to no debt, monthly demands are small. Consider how much cheaper your monthly expenses will be without a car payment, student loans, credit cards, or a mortgage. This makes you more resilient to recession-related dangers. Never mind that you'll get a better night's sleep as a result. How many times have you made a purchase that you later regretted? That new car you bought that's now dented, has frequent mechanical troubles, and is worth next to nothing. What about the timeshare you were sold while on vacation, or the lavish wedding you hosted, with 300 guests to marry your now ex-husband or wife? There's nothing wrong with spending money on these pricey items if they're essential to you and provide you with joy. But the issue arises when people make huge and minor purchases without thinking. Spending money on things you'll forget about in a few days, weeks, or even months after buying them is a sure way to empty your wallet. When you lose your job or your retirement funds decrease in value due to a market crash, these pointless, forgotten expenditures will leave you wondering where all of your hard-earned money went. Your future self would appreciate you thinking twice before purchasing an expensive item or carefully evaluating whether or not you want to indulge. You'll get more enjoyment out of each dollar spent if you don't make a purchase that will be forgotten soon afterward. When the stock market crashes or a recession occurs, it appears like the world as we know it is coming to an end. Will things ever be the same again? It's worth remembering that according to Acorns, the average recession occurs every 4 years and lasts roughly a year and a half. The average bear market, which occurs every 3.5 years and lasts between 9 and 10 months, occurs every 3.5 years, with an average stock market decrease during these periods being around 35%. In short, you may expect the stock market to plummet 35% on average every 3.5 years, but don't worry, it usually recovers in less than a year. When your investments lose a significant portion of their value, it's always unsettling, especially as you grow older and replenishing those funds appears to be impossible. That's your hard-earned money disappearing into thin air. But when you look at history and know what to expect, these events become much more bearable. Remembering that markets aren't always upbeat, we recommend preparing your portfolio for such events and avoiding anything you wouldn't want to hold if a downturn occurs. Maintain a safe level of leverage at all times, which means don't borrow more money than you're comfortable with at all times. When the economy was doing well for a few years, buying stocks on margin appeared to be a safe bet. But what happens if things go south? Would you still think that's a smart plan? Or are you already overextended? What about your home equity line, which allows you to borrow against a significant portion of your house's worth while leaving you with little to no equity? You can easily make the payments today, but what if your income drops? Borrowing money offers tremendous upside, but you must be exceedingly careful not to over-leverage, which you can accomplish by examining each market cycle. The bigger the market or economy gets, the bigger the profit prospects become. Be fearful when others are greedy, and greedy when others are fearful, as Warren Buffett once said. When assets recapture their all-time highs, investors who are ideally positioned to acquire them at a bargain are sometimes richly rewarded. While buying the dip, the basic investment strategy of buying low and selling high is followed. It's akin to market timing. While completely timing the market is tough, buying stocks at a steep decrease in price with the purpose of keeping them for a long period is a straightforward method. This is only a good idea if you have a lot of money to risk by investing. A recession, on the other hand, may herald an opportunity for people with extra cash to invest. It's all too easy to forget how things were during previous recessions, especially for younger people who have little or no memories of them. When the economy is booming and apparently unstoppable, the dark times fade away. Remembering these periods and being prepared for them can put you in a far better position to sustain a loss of income, a significant decrease in the value of your portfolio, and even allow you to take advantage of incredible market value. Compare this to someone who is unprepared and expects nothing less than a great economy with steady gains in their investments, who may lose their home, face serious family troubles, and face a slew of other negative consequences. And that's all. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell. If you have any questions, feel free to leave a comment down below, and I'll see you in the next video.